How can you profit from commodity spread trading? Imagine turning small differences in prices into a steady source of income. That's what commodity spread trading is all about. It might sound complicated, but it's really about understanding how prices of related contracts move together. When you trade spreads, you buy one futures contract and sell another at the same time. This way, your profit depends on how the price gap between these contracts changes. Instead of betting on the overall price of a commodity, you focus on the difference. This can make your trades less risky because the spread often moves more predictably than the entire market. There are different types of spreads. Calendar spreads involve buying and selling contracts of the same commodity but with different delivery months. For example, you might buy a crude oil contract for delivery in July and sell one for December. If the price difference between July and December contracts widens or narrows in your favor, you make a profit. Seasonal factors like winter heating demand or summer storage costs often influence these spreads. Intercommodity spreads involve related but different commodities. For instance, you could buy Brent crude oil futures and sell West Texas Intermediate crude futures. The goal is to profit when the price relationship between these two changes, often driven by regional supply or demand differences. Interexchange spreads involve trading the same commodity across different markets. For example, buying gold futures on one exchange and selling on another to take advantage of price discrepancies caused by local market conditions or time zone differences. There are also specific strategies like the bull futures spread, which is used when you expect the near-term contract to increase faster than the longer-term one. For example, if you think winter demand will push near-term heating oil prices higher, you might buy a nearby contract and sell a later one. Conversely, the bear futures spread is used when you expect near-term prices to fall faster, such as selling a soybean contract for delivery soon and buying a later one if you believe supply will increase. Trading spreads offers some clear advantages. You usually need less margin because your risk is offset between the two contracts. This means you can control more positions with less money. Since you are betting on the difference rather than the entire price, your exposure to market swings is lower. Understanding seasonal patterns and supply-demand fundamentals helps you decide when to enter and exit spread trades. For example, knowing that harvest season in agriculture tends to narrow or widen certain spreads can guide your decisions. Managing the timing of rolling over contracts before they expire is also key to maintaining profitable positions. To succeed, you need to analyze historical price relationships, keep an eye on supply and demand factors, and execute trades efficiently. Controlling transaction costs and choosing the right spread ratios are essential. In the end, commodity spread trading can be a smart way to profit from the natural relationships between related contracts. It's about understanding how these relationships change over time and using that knowledge to make disciplined, strategic trades.